Subscribe to our YouTube channel and press the bell icon to get the latest updates.
Hi guys, Rahul Shah here, trying to make investing accessible and profitable for the average investor. Now, I'm going to touch upon a very important topic today. Topic about selling, when to sell your stocks. Now, I've made a video about this a few months back as well. And if you've already gone through that video, please do not skip this one, because I think I'm going to approach selling in a different way, or I have approached selling in a different way in this video, which I think you would find useful. Now, an honest confession before I begin: selling is difficult. I think it's many times more difficult than buying. And the reason this is the case is because I think you have to be a lot more rational and a lot more independent in your thought process when you are selling. And as humans, it is very difficult for us to do this, because all sorts of biases creep in when we try to sell something. In fact, even Warren Buffett has spoken a lot about this over the years, and you can make out from whatever he said that how even he finds selling to be a very difficult art to practice. One of his most famous statements being, never count on making a good sale. Have the purchase price to be so attractive that even a mediocre sale brings good results. So forget about selling at the perfect price. Have the purchase price, or buy on such attractive terms that even if you don't sell it perfectly, or even if you do a mediocre job in selling, you'll still end up with good results. But of course, it's Warren Buffett, it's him, and his whenever he buys something, and unless the fundamentals deteriorate, he continues to hold on to it for years. His buying period, as we all know, as he famously keeps saying, that is forever. For us retail investors, though, our holding period cannot be forever. It could be for few stocks, but not for all the stocks in the portfolio. It is a lot of the stocks that we have in our portfolio. It is very important for us to try and sell it at a decent time, or at very close to the right time as possible. Because if we don't do that, the stock may again fall down in the subsequent crash, and we may lose the opportunity. So for us, it's definitely important to have certain broad guidelines or certain rules when it comes to selling. And this is what I'm going to highlight in this lecture over the next 10-12 minutes. And I hope that you find these pointers to be useful. I have definitely found them useful in my career, and I hope the same for you. Now, why am I talking about selling? Why am I making a video around selling right now in the current environment? That's because I think we've had a fantastic rally last 17-18 months. I think it's definitely been one of the best rallies that I have seen in my career. Sensex up 130-140% last 17-18 months. If you had invested back in March 2020, I think your portfolio would have been sitting on 2x gains, 3x gains, even 4x, 4 times returns in some cases. So that's good, that's phenomenal. But we also have to remember that this period may not last forever. You can't keep having 80-100% gains year in and year out. And the faster the gains come, the stronger is the chance of correction. In fact, there are already murmurs doing the rounds that we may be at the beginning of a correction. But to be honest, I don't want to predict it. I don't think anybody can predict when a correction comes. But it's always a good idea to be prepared. It's always a good idea to know where your portfolio stands, where the stocks in your portfolio stand, so that when a correction comes, or when you decide to lighten up or sell, come out of a significant chunk of a portfolio, you know exactly what stocks to sell, and what kind of an approach to take. Because in the middle of a correction, in the middle of a 10-15% fall in the stock market, if we don't have a good idea of which stocks to sell, and at what price, we may end up pressing the panic button, we may end up taking all the wrong decisions, and it could lead to a disaster for a portfolio. So it's definitely a good idea to keep some broad pointers in mind, to keep some broad rules in mind, and which is what I'm going to discuss in this video. So an approach that I have found useful when it comes to selling in my career is trying to divide the stocks in your portfolio into three different buckets. The way I look at it is, which are the stocks in your portfolio which, even though they fall in a crash, they may recover and go on to make new highs 5 to 10 years down the line, 15 years down the line. So, does your stock have this? Does your portfolio have this kind of stocks, which even though they fall, they recover and they go on to give good returns over the long term? Now, think of this as something like the Sensex. Sensex, the benchmark index, has gone up 600 times over the last 40 odd years, and it has seen a lot of crashes in the interim, but it has recovered and it has gone on to achieve new highs and give those good long-term returns. Why the Sensex has been able to do it? Because it has been able to grow its top line and bottom line. By Sensex, I mean the Sensex companies. So the Sensex companies have been able to grow the top line and bottom line at 15-16% per annum, and the share price have also followed suit. So are there stocks in a portfolio, high quality stocks, which you think will continue to grow at 15 to 16% at the rate of the broader economy, or perhaps even more, and be around 10-15 years down the line? Uh, does your portfolio have stocks of the likes of, say, Asian Paints, Pidilite, Page Industries, Nestle, HUL, these bluest of blue chips that will be around 10-15 years down the line, that will be creating new profit records? If the answer is yes, if you have these kind of stocks or exactly these stocks in your portfolio, then maybe you may not want to move out of these stocks unless you need money over the next 1 to 2 years. If you need money over the next 1 to 2 years, you may maybe exit partially. But if you don't need money over the next 1 to 2 years, if you're willing to hold on to your stocks for the next 5-10 years, and if you bought these high quality stocks at attractive valuations few years back, then there is no reason for you to move out of these stocks, because even if they fall in a market crash, they will recover and they'll continue to give you those great long term returns. So that's the first bucket: stocks which fall but recover and go on to make new highs. The second bucket is stocks which move like a pendulum between two price points. If the stock is at 100 rupees in a bull market, it falls to 30, 40, 50, 60 rupees, in a bear market, then again goes up to rupees 100 in the next bull market. So these are the kind of stocks where if you bought them a year and a half back, and you're sitting on 50, 100, 150%, 200% gains on these stocks, maybe perhaps it's time for you to move out of these stocks, because these stocks, when a crash comes, they fall, they again recover, but they don't go past the previous highs, or they keep moving like a pendulum between two price points, uh, between different market cycles, right? So if you have this kind of a stock where the top line, where the industry is saturated, the top line of the company is not growing a great deal, the bottom line is not growing a great deal, it's meandering along, or it's growing at 5, 6, 7% rates, single digit rates, and where the future is, where the company may continue to be around 5 years, 10 years down the line, but the growth is not going to be there, then if you are making 100 200% gains on such stocks, perhaps it's time to exit the stocks and take the money out and put it into a similar stock, or put it in a bank. Now, most of the services that I manage at Equitymaster deals with these category of stocks. So what I do here is, I put a lot of money into these stocks when after the market has crashed, or in a market environment which is undervalued, in a stock market which is undervalued or fairly valued, and I take a lot of money out of these stocks and stay in cash in a market environment which is, moderately overvalued or significantly overvalued, like it is right now. You get a lot of these kind of stocks in a market which is cheap, which is undervalued, or which is fairly valued, and as markets continue to rise, as we move from a bear market to bull market, the number of such stocks, decline, available at decent valuations decline. So right now, these kind of stocks are few and far between, and therefore, if you have these stocks in your portfolio, perhaps it's a good idea to sell them and move into cash. As far as my service is concerned, I think I'm sitting on 45, 50, 55% cash across most of my services, because I mostly deal in these kind of stocks. And once I have exited, I've recommended my subscribers to move out of these stocks. I'm not getting enough uh, new stocks at the valuations I want, and therefore I've asked them to be in cash. So this is bucket number two. Bucket number three is, of course, stocks which are being touted as the next turnaround candidates or turnaround stocks, but there's been no turnaround of any kind so far. Stocks which are of bad fundamentals, have broken balance sheets, have been recording losses over the past few years, but have gone up 3, 4, 5 times in the name of a bull market or in the hope that they'll turn around. These stocks, I think, they should be moved out of, unless you are thoroughly convinced that the company is going to turn around. In fact, even if you're convinced, and if even if it's not reflecting in the financial statements or the balance sheet of the company, it may be a good idea to take your initial capital out and let the profits be in the store. Take your initial capital out, and the profit that you made, let that be in the stock, and uh, let that go up or down depending on how the stock performs. These stocks are speculative stocks in my view, and they should not form more than 10 to 12% of your overall portfolio. If it's forming a significant chunk of a portfolio, if a portfolio has 20-30% allocation to stocks which are junk, which have recorded losses over the past few years, it may be a large cap doesn't matter. It may be a large cap, it may be a mid cap, it may be a small cap, doesn't matter. But if it's loss making, if it's highly leveraged, uh, it may be a very good idea to exit partially or exit completely out of the stocks at the current market levels. So this is these rules or these principles, I personally found to be extremely useful when it comes to selling, when it comes to taking a sell decision about the stocks in your portfolio, when it comes to assessing your portfolio. Uh, Remember the three buckets. Bucket number one, extremely high quality stocks which may fall during a crash but may recover and go on to make new highs. Bucket number two, stock swinging like a pendulum between two price points. So if it's gone up 50, 100% after you've bought them, uh, it may be a good idea to move out of these stocks and put the money into another similar stock or stay in cash. Bucket number three, speculative stocks which may fall during a crash but may not go on to recover. Better to exit these stocks, uh, fully. Now, it's an art, right? And a lot of times, what may happen is a stock which you thought is bucket number one may actually you later realize that it's bucket number two, or stock which you thought is bucket number two, later on you realize is bucket number three, or the reverse. A stock which is a genuine turnaround candidate, which is a bucket number three stock, which you thought is a bucket number three stock, but shows such dramatic improvement in performance that it goes on to move into bucket number two, and then it moves into bucket number one. It can happen. It is not science, it is art. So these things keep happening, but as long as you keep these broad rules in mind and follow these principles while uh, trying to take a sell decision around the stocks in your portfolio over the long term, I don't think you'll get a bad return from your investment. I think one thing that value investors like us need to learn from traders is to be very disciplined. Traders are very disciplined about buying and selling. They have definite rules when it comes to buying and selling, and this is what we should learn from them. Of course, we cannot have very definite rules like traders do, but having broad thumb rules, having useful pointers like the ones that I just highlighted may go a long way in helping you take the right sell call at the right time. So yeah, do let me know what do you think of these rules. Do you think that using them may help you with taking the right sell decisions more often than not? I'll await your feedback. In the meanwhile, do not forget to like, subscribe, comment, and share on this video. Your feedback is very very important to us. So do keep it again. Do keep it coming. Sorry, and I'll see you again next time. Take care. Thank you so much.